Ladies and gentlemen, welcome to the Banking Technology and Dell webinar on the subject of streamlining KYC operations, ensuring compliance, and putting the customer first. We will be discussing today how to ease the pain in KYC and customer onboarding, how to deliver speed, agility, efficiency, and to ensure compliance and to put the customer first. And today with us, we've got David Harvey, who is a Principal Consultant, Banking and Securities Practice at Dell Services, Owen Kennedy, Group Head of AML, CFT and Sanctions at the Bank of Ireland, and David Miller, Senior Analyst at JWG. And before we begin, just to let you know that we will have a Q&A session at the end of the presentation, and it will be a live Q&A session. So if you've got any questions to our speakers and presenters, please submit them via the chat box in your consoles, either during the webinar or at the end. Thank you very much. And now over to you, David, for the presentation.
Thank you, Tanya. Know Your Customer, or KYC, used to be a very simple and straightforward process when I started out in banking all those years ago. A new customer had to present themselves in person in a branch environment and with suitable identity documents such as passport or driving license or a number of utility bills. And the bank simply verified the customer's identity. They would also check that they weren't on an internal blacklist. And the interview was conducted by a manager or chief clerk in the branch, who would also conduct a risk assessment of the person sitting in front of them and decide whether or not to open the bank account. But now, in the new digital age, you may never meet your customer face-to-face. So, do you really know your customer and who you're dealing with? Add to this the seemingly never-ending new regulations, the need to deliver an enhanced and consistent customer experience, the advances that new technology now enables, plus the compliance officer's demands to standardize the KYC processes, and this becomes a very complex function for the banks to deliver. If we look at regulation, in particular the recent new regulations, KYC has now become inextricably linked to anti-money laundering regulations, fraud detection, and sanction checking, along with a typical identification. And the recent fourth European Anti-Money Laundering Directive also introduced a new risk-based approach to KYC onboarding, something that the branch manager used to apply with the person or the company sitting opposite him during the account opening process. And considering that most banks have some international operations these days, we calculate that there are some 18 or more regulations existing today across the world that a bank needs to comply with, and all in the same compliant way. And in today's new digital age, customer experience and customer expectations are being set by superior interactions with the likes of Amazon, Facebook, Apple and Google, and the airline and hotel industries who are setting the pace, to name but a few. How easy is it to find out information about opening a bank account with the bank? How difficult is the onboarding process? How long will it take to open my new account? If it's easy and intuitive and it's responsive with help when you need help to complete the onboarding process, and the account is open more or less immediately, then your new customer already likes you. They've had a positive experience. And if they like you, then they're more open to the idea of buying more products and services from you at the right time and the right price. On the other hand, 89% of the customers who leave the bank within the first 3 months of becoming a customer actually blame a poor customer experience during the onboarding process. Advances in new technology are making all areas of banking much easier to deliver these days. The emergence of toolkits and platforms and services over the last 10 years have made it much easier to address many of the challenges that exist within the bank's legacy systems. And I'll talk a little bit more in a little more depth about Dell's KYC solution and the services that we offer in a little while. And how do you standardize your KYC processes across multiple lines of business, across consumer banking, small to medium enterprise, business banking, corporate banking, institutional banking, and across multiple geographies and multiple regulators across the world? This is one of the biggest challenges facing compliance officers today, and they're all asking the business, IT, and their colleagues in operations, how do we make this easier? In practice, and based on the many conversations that we've been having with the banks, it's not easy, and most have not yet standardized and automated their KYC processes. This means that they still have inconsistent and manual intensive processes, which in turn is leading to heightened scrutiny by the regulators. If we had a close look at a few of the new regulations, some of them are actually very helpful. The Financial Action Task Force, FATF, is an intergovernmental body established in 1989 to help develop and promote policies to combat money laundering and terrorist financing. But also the US Office of Foreign Assets Control and the UK's Treasury have both introduced the penalties of economic and trade sanctions against certain countries, organisations or individuals, which introduced the need for screening as a key part of the KYC process. And as I mentioned earlier, the fourth EU AML directive introduced a risk-based approach to KYC, something that the branch manager used to perform in the early days of branch banking, and led to all banks to revisit and remediate their entire customer portfolio and bring their records up to date. Risk profiling customers is now an ongoing process and a considerable burden to the banks. And whilst all of this has been emerging, the banks themselves have been very busy since the financial collapse of 2008, rebuilding their balance sheets, reallocating capital around the products they want to use going forward, reassessing the markets in which they want to operate. Have the regulators been sympathetic with the banks during this process? Well, the short answer is no, they haven't. For money laundering breaches and other failures to comply with existing regulations that have been in place for some time to allow the banks to adapt and comply, 20 of the global banks have been fined a total of $235 billion, an enormous sum of money in anybody's books. These new regulations and the associated risks resulted in hundreds of bodies being deployed to bring KYC operations up to date. Perhaps inevitably this has also led to inconsistent and many manual processes, which in turn is leading to high costs, duplication of activities and inefficiencies. Also in turn, this has also led to poor customer experience and potential non-compliance. And the lack of a comprehensive enterprise single customer view has led to more customer frustration. For example, an existing customer of a full service bank maybe having an existing account in the consumer bank may well find themselves having to re-identify and enroll if they want to open an account in, say, the wealth management division or the investment bank, all at the same bank. Our banking practice has both watched this from a distance and been directly involved in certain parts of the KYC process for our own customer base. And what we saw appeared to be a lot of disjointed and manual intensive processes in nature. So then we thought, this is crazy. How can we as a technology and services provider make this better? We analysed all the functions, the processes and the components and data feeds to create a KYC framework, and then we added some of our own applications to actually complete what we're now offering as an end-to-end KYC solution. So essentially we're automating what can be automated in the KYC process, and then providing lower cost nearshore or offshore skilled BPO resources to undertake the necessary manual due diligence checks and investigations that take place in everyday operations. Now, all of this was designed to simplify operations, automate what can be automated, ensure compliance, and at the same time deliver a great customer experience and a fast outcome, which is essential in the digital age. Now, I should add that these are, the overall solution is made up of several individual components to create our overall KYC solution. And this is to recognise the fact that all banks are already performing KYC operations, but maybe not as efficiently and as effectively as they would like. So they may have some of the existing components that we offer already. Such a bank may be interested in either taking the entire end-to-end KYC suite or certain components in isolation to complement what they already have. So let's have a look at these in a little more detail. First of all, we've developed a KYC maturity model to assess what the bank already has, where they currently are, define the as-is model, and then also define the journey of how they get to where they want to be, the to-be model. We've developed a KYC corporate mobile front end, so relationship managers who are meeting with corporates can actually use their smartphone in their pocket to initiate KYC searches whilst they're with the customer. We've brought in our customer experience methodology and our customer journey mapping, which is a key part of that, to actually make the customer experience, the journey, how easy it is to actually use the bank's channels and processes to actually become a customer, to make that a more enjoyable experience for the customer. We've automated the identification and verification services delivered typically by a credit reference agency who provide those services. We've also automated a feed from Companies House through third-party agencies, but on a real-time basis. So whenever a director leaves or joins the company, this can be reported real-time into the back office operations and investigated real-time to keep all the records up to date. We've also developed what we call a mandate entitlement engine. So the customer signs up to become a new customer. We then record the fact that they're also eligible to apply for other products and services within the bank across multiple lines of business without the need to re-enroll and go through the KYC process again, a point that frustrates the customers no end. We brought in our advanced analytical tool, Statistica, to address false positives, the large number of false positives. I've mentioned how we do that before, working both with the bank's structured data and external unstructured data. At the heart of what we do, we've brought in a KYC platform, but one covering all lines of business, consumer, corporate, institutional, all from the same centralized platform. I've talked a little bit about the BPO resources, the back office resources that we can deliver, and as part of that we actually bring in our robotics automation capability for those simple, manual, repetitive tasks that an agent may have to perform. Why not have a robot perform those for them and just save a little bit of time? But over hundreds of thousands of customers, that adds up to a major cost saving for the bank. We brought in our Boomi integration capability to help rapid integration across cloud services to link with the bank's front end and its back end systems and the various other components that the bank will wish to integrate with KYC operations. And then we've wrapped it in data protection and security with our secure works capability. And what are we trying to address with this KYC solution? Well, the typical challenges that we see within the banks fall into sort of four areas. The first one is around the task of customer acquisition, where an onboarding and KYC request, it needs to be supported through all the channels in the same way. It needs to be standardized. The customer experience needs to be consistent across all of these channels and easy to use for the customer to navigate their own way through the process. And the onboarding and KYC requests need to follow an automated workflow rather than any manual tasks. The second area is the area of customer due diligence as part of the KYC process. So we've streamlined workflow. We've introduced a streamlined workflow application to manage all of KYC cases. We've developed coverage of multi-level ownership for corporates across multiple geographies and multiple structures, corporate structures. We've provided an end-to-end screening of both structured and unstructured capability, leveraging the advanced analytics capability that I mentioned before. So we've optimized the number of false positives and hit investigations required by the back office. And we apply an efficient risk categorization for remediation purposes for banks that are actually going through their remediation process, as well as ongoing risk categorization for any new customers. The third area is around customer setup and platform integration. So we've delivered a seamless KYC platform integration with the end-to-end solution to ensure that costs are reduced, particularly when you also have to integrate with back-end systems such as the core engine or multiple core engine systems, anti-money laundering systems and fraud detection. And you also need high customer and data security during a customer applying themselves through one of the channels. The access, transmission and transfer of that data across the enterprise. The fourth area is in back office operations. So I mentioned before, we now deliver through our own BPO capability highly skilled agents but delivering a lower cost of operations with business processes optimized and automated where they can be. And again, introducing robotic automation where this can be introduced to make the process as efficient as possible. And we also support multiple countries and products and languages and regional regulations. At the moment, we're covering 26 countries, not only for existing, but also for upcoming regulations as well. So what does a centralized and automated KYC solution look like? Well, this is a blueprint of what such a system would look like, and it may well be familiar for those of you already working with the bank's existing KYC capabilities. So we have a centralized KYC platform at the center, but we're also integrating with CRM and branch platforms at the front end. We're integrating with external watch lists and sanction checking as part of the screening process. We're reaching back into the back office through to the core systems, which are transactional processing engines and customer information files at the back end of the banks. And we're linking directly with their back office anti-money laundering and fraud detection systems as well. So the functions we're operating or offering is new customer onboarding. We're also offering remediation, the ability to take the back book and remediate the process, but again, using the modern centralized KYC platform to manage all the processes and the caseload for doing that. So we're delivering screening and real-time feeds of changes in the corporate, in company's house. And we deliver this to be able to cover all the different lines of business that a full-service bank has. So retail banking, consumer banking, corporate banking, wealth management, asset finance, investment banking. And applying a risk categorization to the portfolio of customers that you're actually processing through this system. And what are the benefits that we see by using a centralized and automated system like this? Well, typically we see a reduction of overall costs by around about 30%. And we also see an improvement in the bandwidth of the relationship managers on the corporate side with their corporate customers by around about 25%. So they're spending more of their valuable time working on the relationship with the customer rather than the administrative tasks involved in delivering a KYC process. And what does it mean for the customer themselves? Well, what it means for consumers using an automated system, the ID and verification capabilities and screening. Typically now you can apply and become a customer in a matter of seconds, and certainly less than a minute rather than typically it used to take hours and maybe more than a day. And for the corporates, typically now we see a corporate being onboarded within a matter of hours, and usually less than a day, whereas before it was taking up to a week or often 10 days to actually bring on board a new corporate customer. So these are real benefits for the customer, as well as the other benefits that an end-to-end solution like this one will deliver for a large, full-service, multi-geography, multi-channel retail bank. And that concludes my presentation. Thank you.
Well, thank you very much, David, for this brilliant presentation. And I have a couple of questions for you. So my first questions are, what's happening in the regulatory landscape? And in your experience, what are some of the newer KYC approaches and solutions that we see in the market today?
Yes, well, in terms of the regulatory landscape, as ever, we're all anticipating yet more regulation, and there will certainly be extensions to our existing regulations. Some of those I've mentioned to you, particularly as new technologies and new capabilities come forward. And I'm thinking particularly about the role of blockchain and what it may well do around customer identification in the relatively near future. And it's interesting, the UK regulator is taking a very open view towards blockchain technology and what its potential impact and benefits towards banking will be, which I applaud, I have to say. In terms of some new KYC approaches, we're seeing some fintech providers actually looking at KYC and the whole role of identity and sovereign identity, the ability to provide an individual with an identity that they can take everywhere. And we're seeing something of that in the European EIDAS initiative that's taking place in July this year. The ability to send a digital signature that's recognized, and if a country creates its own digital identity, then other countries within the European Union will also adopt that approach for those customers who do so. In terms of solutions, we have solution providers like us who are providing an end-to-end capability, a complete suite covering the entire life cycle of the KYC operations, and post-origination, post-acquisition, where you're also addressing ongoing risk profiling of your customer base. And we then also have other providers who are providing components in a more modern, more efficient, easier to access capability, or providing data in that way. So we're seeing that, and that will play towards those banks who are in the process of developing their own capabilities, although of course our own capability plays in that space as well.
Thank you, David. And so what constitutes a comprehensive, integrated, end-to-end KYC solution?
So I would answer that very much from our perspective. So it's where you have a centralized, highly automated platform that's integrated with all the other components through the platform to deliver an end-to-end capability. That then allows making it relatively future-proof going forward as new regulations may emerge and new data may need to be captured. But in fact, that was not really possible until the relatively close future. It's only recently that we've identified the possibility of developing such a solution, and have now brought it to market with our friends at Bank of Ireland, which Owen has talked about. So I would say it's that sort of centralized, automated KYC platform with integration to all the other components that make it a complete solution.
Mm-hmm. Okay, and what type of automation can be provided, for example, to assist in searching structured and unstructured web sources?
So the automation itself is provided by workflow. In terms of data, typically the banks tend to use their own data or data from a third party, such as an ID and verification agency or what have you. The emergence of unstructured data now allows banks, through their various listening capabilities, to actually capture more insight about individual customers. Now, of course, you've got to be very careful not to contravene data protection regulations and the various ways that you can actually do that, not least within the terms and conditions of your products, and actually making it very clear that you may well perform those functions as part of your operations. And you can also apply advances in technology, such as advanced analytics, to actually reduce the number of false positives, for example, using probabilistic and deterministic modeling capabilities.
Mm-hmm. And what about the governance? What type of governance might be required across business and technology functions to ensure a comprehensive approach?
Well, you absolutely need that governance across all the parts of it. So it's business, technology, and operations as well. And the banks typically have a chief compliance officer appointed who takes personal and corporate responsibility for ensuring compliance with their existing and new regulations. But he in turn will work with business, technology, and operations to ensure that processes are identified, operations have service level agreements with them, and the processes and the bank's approach is applied across the entire enterprise, all the lines of business and all the geographies that they operate in.
Oh, thank you, David. And so does it make sense to centralize KYC operations onto one platform and to best shore, so to speak, the delivery model?
I think it does, because you can now actually achieve that with what we're offering, or build your own. But why would you when there's one already available in the marketplace that allows you to centralize operations in one place, but also cover all lines of business and all geographies, and with lower cost resources for where you do need people, skilled people, to use their own eyes and their own experience to actually look at some information and make a risk judgment call on it as part of the KYC onboarding process. So yes, it absolutely makes sense to centralize operations. And by doing so, you're doing two things. You're reducing your costs by simplifying and automating the processes, and you're also delivering terrific customer experience by making it easier for the customers to actually use your onboarding capability. The third area, of course, there should be three areas: ensuring compliance at the same time and standardization across all your operations.
Great, thanks. And so now to my last question. What is the best customer experience in the delivery of a KYC solution?
Well, you need to look at this from the customer's perspective. If you were in their shoes, how easy is it to become a customer of your bank? I mentioned before, how easy is it to find information about a product? What information do I need to provide to very quickly go through the origination process? And it needs to be easy to use, intuitive, and responsive with help, with chat functions that can step in and help you if it senses that, in fact, you're laboring on a particular question or whatever it may be. And most of all, it has to be quick in terms of confirming that you are a new customer of the bank, be that a consumer customer or be that a corporate customer.
Great. Well, thank you very much for such comprehensive answers, David. And we are now turning to the industry perspective and experience of the Bank of Ireland.
So we are now here with Owen Kennedy, who is Group Head of AML, CFT and Sanctions at the Bank of Ireland. And thank you very much for joining us, Owen. And we've got a couple of questions for you to hear your industry perspective. So my first question is, what are the issues facing the bank in terms of the regulatory pressures and customer experience, particularly around loan processes?
Okay, Tanya, thanks. So I suppose what we're seeing are that regulators are continuing to aggressively supervise financial institutions in line with their financial crime obligations. And I think this is particularly evident with the number and materiality of recent enforcement actions that we've all seen against banks. I think it's important to note also that regulators themselves are being subjected to a lot more outside scrutiny, particularly through the FATF-IMF mutual evaluation process. And it's really against this backdrop and against the backdrop of an elevated financial crime threat that it is expected that regulatory maturity and expectation will definitely continue to develop at an accelerated pace. And we certainly also expect that close and continuous supervision will continue throughout 2016 and obviously beyond. And we certainly expect to see targeted inspections in high-risk areas and obviously those business lines that we would consider to be higher risk from a money laundering and financial crime perspective. Your other question around the customer experience, we're definitely seeing that customer expectations are definitely changing. There's a significant shift towards digitalization and online account opening. Customers expect banks to be able to adopt a fully omni-channel approach to account opening. And certainly in my view, in order to facilitate this expectation from a financial crime perspective, banks have to be able to automate the customer risk rating process. We need to be in a position to ensure that adequate enhanced controls are triggered for those customers that pose a higher financial crime risk. And furthermore, and finally, I suppose banks need to be able to identify, verify and screen customers in real time during the onboarding process. So that would be my view.
Mm-hmm.
Okay?
Okay, great. Thank you very much. Definitely very interesting. Perhaps further on we can explore this with a bit more detail. But my next question is, so what needs to be covered in a comprehensive KYC solution, in your opinion? Okay, great.
So I'm going to use the terms KYC and customer diligence interchangeably because they're both, very, very similar. So certainly in our view, CDD or customer due diligence is the process by which a bank identifies, verifies, risk assesses and screens its customers. And that's done both at onboarding and throughout the life cycle of the relationship with the customer. In my view, a comprehensive KYC solution has to incorporate each of these elements, so identification, verification, risk assessment and screening, and it has to do so in a way that actually complements and doesn't conflict with the account opening process. So in a kind of a nutshell, I suppose, a comprehensive KYC solution should firstly digitalize the KYC process at onboarding. And, I would have seen that KYC processes so far have not really kept pace with technology. Account opening is now becoming more online and real time, but as we've all seen, an awful lot of the KYC and CDD processes that are out there are still very manual and are still very much based on paper. And secondly, I think a comprehensive KYC solution must drive consistency and quality right throughout the business. So to expand a little bit further on that, banks have to be in a position to be able to actually demonstrate that the CDD processes they have implemented to meet both their regulatory and policy requirements are consistently and effectively applied right throughout the business. So how effectively these requirements are met can't really be dependent upon, for example, the channel through which a customer is onboarded or the individual who's onboarding the actual customer. You can't have a situation whereby the level to which CDD is done is dependent on the branch that a customer goes into. A bank has to be able to rely on the fact that it has a much stronger process than that, and no matter what channel or what staff member a customer is actually dealing with, that we as a financial organisation can be satisfied that the CDD processes are being done effectively and consistently. Thirdly, in my mind, a comprehensive KYC solution should make sure that the customer risk rating process is actually automated. So the risk rating of a customer, it should be an objective determination of the level of risk presented by a customer based on predefined risk criteria. So the objective determination should be driven by an automated risk assessment tool. I mean, the alternative to that is a purely manual and a subjective assessment of risk, which certainly in my view is neither reliable nor consistent. So to recap there, the automation of the customer risk rating process is very, very important. And fourthly, I think a comprehensive KYC solution should facilitate real-time feeds from trusted data sources, which would include, for example, the likes of the company's houses. And this would facilitate identification and verification of customers using data from reliable sources while driving a digital and more customer-friendly onboarding journey. And this is one of the examples where a KYC process can begin to keep pace with what's actually happening out there, and we have a situation then where the onboarding process is not conflicted or is not stopped by the AML processes that a bank follows, but more so actually it's completely complemented by that. I think also it's important that KYC solution would actually facilitate the real-time screening of customers and the related parties associated with that customer at onboarding, and it would be very important that there is the ability to maintain a full audit trail of any potential sanctions or pet hits that have been is counted. And finally, and potentially most importantly, a comprehensive KYC solution should drive the required senior management review and sign-off prior to the onboarding of a high-risk customer. So where we have an automated risk rating in place and where that classifies a customer as being high risk, a comprehensive KYC solution must have sufficient control built into it so that that customer cannot be onboarded until the head of the business is absolutely comfortable and until the money laundering reporting officer is also satisfied that this is a risk the bank should actually take. So I hope that actually answers that particular question for you.
It does indeed. And so, well, that moves us on to the next question. Given the current industry challenges and given the current bank requirements, what is the approach that you feel is appropriate to overcome the challenges and to meet the requirements?
Yeah, so for me, being able to competently demonstrate that CDD requirements have been effectively and consistently applied right throughout the business is absolutely important. It really is. I mean, that's the only way that we can stand over a framework being implemented in a consistent and effective manner. So this includes being able to obviously demonstrate that the risk rating associated with every customer has been objectively determined. It's also very important that this risk rating is used as the basis for the implementation of the bank's risk-based approach. And certainly in Bank of Ireland, we've spent a lot of time now over the past number of years developing a solution that actually drives that for us. And the solution that we actually followed is actually twofold. And firstly, it involves the implementation of, specialist AML and sanctions software right throughout the actual bank. And that software drives the CDD workflow both at the onboarding phase, but also throughout the life cycle of the relationship with the customer. And importantly, it ensures a holistic KYC record is electronically maintained for every single customer. So that would be the first tranche, or the first branch of the solution that we actually implemented, and obviously that we felt was certainly appropriate to overcome the current challenges. Secondly, however, and this is where we would have worked very, very closely with Dell, we have established offshore KYC centers of excellence, and the whole purpose of those is to drive consistency and quality right throughout the bank. So the advantage to us in actually adopting this particular approach is that it allows the bank's relationship managers to focus on the risk assessment element of the CDD process. So essentially this means that our relationship managers are now spending more time getting to know and getting to understand the customer. And that's driven by quite a lot of deep risk assessment questions that we ask. But all of the rest of the KYC process, so all of the administration around it, all of the screening, all of the pulling all of this information into a central record, all of that is then done, governed and managed by the KYC Centre of Excellence. And for us, again, it drives an element of consistency, which is absolutely important. It drives effectiveness. But it also makes sure that the resources that we employ in the bank to actually manage relationships with actually customers, that they're not spending all of their time chasing paper or chasing information. They're spending the time they would have spent chasing the paper in the past, now spending that time understanding and getting to know and spending more time with the customer to get a better understanding of what that customer does and the level of risk that the activities the customer undertakes poses to the actual bank. So again, Tanya, I hope that addresses that question for you.
It does indeed. Thank you very much. And well, thanks a lot for such comprehensive answers. That's brilliant. Is there anything else that you would like to add before we move on?
No, again, I think it's just to actually recap. Things are not getting any easier, and regulator expectations certainly aren't actually going away. I genuinely do think it's time for banks to begin to think how they genuinely manage this risk. And the way it's been done before, the actual manual kind of nature of it certainly doesn't marry with the way customers expect accounts to be open. So for me, and certainly the approach we've actually taken over the past number of years recognises that it's very important that financial crime systems and financial crime controls keep pace with where customer expectations are going. And that would certainly be my parting thoughts.
Great. Okay, well, thanks again. And we are moving on to a panel discussion now, which will include you, Owen, and Dell's David Harvey.
Okay, great.
So we are here with Owen and David to answer some general questions around the industry. And without further ado, my first question is, should banks address the problems of KYC and onboarding individually, or should it be done as an industry? And perhaps, Owen, you could take that question?
Yeah, perfect. So I suppose my own view on this one is, while industry solutions and an industry approach are always very, very helpful, and it is always great where an industry combines to tackle a common problem. I think it is very important for banks, to always realise that we have our own obligations, and every bank adopts its own risk-based approach. And every bank has got its own responsibilities to the regulators that oversee it and its board. So, I suppose my own sense of kind of this one is every bank is going to have to, make sure that it's actually addressing its kind of issues itself. If there is an industry approach being kind of taken to it, it's great to be able to obviously leverage off of that. But in terms of placing full reliance on that, that isn't certainly something I would do. And I do think it's important, as I had said earlier, in terms of the requirement to make sure that we keep pace with where the account opening processes and the customer journeys are going. I would hope that banks do get, I suppose, sufficient leeway from, regulators and overseers to give banks the chance to actually innovate and to, do everything that's obviously needed to make sure that we're addressing and managing the risk as effectively as we possibly can, but also recognizing that we do need to actually keep pace with how everything else is changing, particularly in terms of customers' views and needs around how they actually interact with actually banks going forward.
Mm-hmm. And what do you think, David?
Yes, I would agree with what Owen shared there. Industry forums are a very useful medium to actually sort of share best practice between banks who all face the same problems, and as a sounding board to actually share industry feedback back to the regulators about particular regulations that they may not be happy with, or that may be actually better phrased or framed. So probably a mixture of the two.
Mm-hmm. Okay, so moving on to the next question. So are institutions able to outsource compliance?
And again, perhaps, Owen, you would like to start?
Yeah, perfect. This will be a fairly quick one. The answer there is no. So institutions are certainly not able to outsource their compliance obligations. They can't outsource their compliance, how they're responsible and how they're accountable for actually meeting their own compliance obligations. However, if there are specific activities that institutions operate as part of their regulatory framework, there's no issue with outsourcing the activity itself, as long as there's a clear understanding that you're not outsourcing the risk, you're not outsourcing the obligation, and you're investing in an oversight program to ensure that the activity that's being done on your behalf by someone else, that it's being done to the required standard, and that you're absolutely happy with it. So, the way I would absolutely answer this one is the ability to outsource your compliance obligations and your compliance responsibilities is an absolute no-no. However, the activities that you undertake to ensure you get compliant, there's no issue with outsourcing those, as long as you've got the right oversight programs, etc., in place to make sure your obligations are being met in a consistent and effective manner.
Okay, that does make sense. And what do you think, David?
Yes, again, I'd agree with Owen. You certainly cannot outsource or delegate the liability to somebody else. The bank must always take full responsibility for that. But on the other hand, the operations and the services and even the platforms, they can be and actively are being outsourced by the banks to a lower cost service provider.
Mm-hmm. Okay, well, in that case, a question for the technology expert.
So, you, David, do you believe that technology solutions are perhaps too slow, too expensive, or maybe too inaccurate?
I don't believe they are. No, on the contrary, I think it's now easier for the banks to adopt new technology that makes life much easier. So the availability now of services, as we mentioned before, BPO services, of toolkits, of platforms, of methodologies, actually make a lot of what the banks now do much easier. And the technology is easier to consume as well. You don't necessarily need to implement it in-house, you can take that as a service as well. So in many ways, it's much easier now to use technology to address many of the business problems the banks face, not least the obligations under KYC.
Okay, and would you agree, Owen?
Yeah, I would definitely, yeah. You know, I think as we'd spoken earlier around the requirement to keep pace with change, etc., you know, the reliance on technology now is absolutely massive, and I think it's something banks have to absolutely adopt, because I think without it just makes it so manual and so difficult to meet obligations in a consistent and effective manner. And I think, again, it makes it very difficult for us to keep pace with where the customer expectations currently lie. So I would absolutely agree.
Okay. Well, another question for David. So is it true that data protection legislation prevents essential sharing of data?
It does, absolutely, and the banks are absolutely compliant with that, to the extent also that certain data in certain countries must remain within the borders of the country. So there's quite an obligation there. However, what I would add is where the customer actually authorizes the bank to share data, and they would do that by signing up to any terms and conditions attached to a particular product or service offered by the bank, then with that authorization, the banks can share that data with third parties who are involved in delivering the particular product or service, or any checks that go along with that.
Okay. And now over to you, Owen. So what are the standards that banks need to adhere to?
Yeah, well, unfortunately there's plenty of them. So I suppose given that we're talking about KYC, I might split this out between sanctions and money laundering and terrorist financing. So quite simply in relation to sanctions, and again all of this very much depends on where the bank operates, but you know, an awful lot of banks have got you know, a presence in, you know, many kind of different countries. A lot of banks will have presence in both Europe and the US. So any European bank in terms of sanctions is going to have to meet the EU sanctions obligations, it's going to have to meet the UN sanctions obligations, and if you have any presence in the UK, the specific obligations that are brought forward by the HMT. In addition then, any bank that has got operations in the US, there's fairly onerous obligations there through OFAC, and all of those particular obligations would be very, very important to meet. In relation to money laundering and terrorist financing, again, you know, this is pretty much dependent on where the bank operates, but, you know, recognizing that obviously many banks have got presence, you know, in kind of many countries. Again, any European bank is going to be required to meet the legislation, the actual domestic legislation that's driven from the European directives. And there'll be equivalent legislation for obviously banks that are operating outside the actual EU. In addition to the legislation itself, then there's quite a lot of guidance that comes from regulatory bodies. So the joint money laundering steering group, for example, in the UK, there would be quite a lot of guidance that would come from the likes of the FCA. So again, on top of the specific regulatory obligations, there's quite a lot of guidance out there that, you know, banks are obviously expected and to a large extent required to meet. There's also been a lot of guidance and standards that are set by the global standard setters. So I suppose when I say that, I'm talking about the likes of FATF, the likes of the Wolfsburg Group, the likes of the Basel Committee. And so I think when you tie all of that up, I think it makes it very, very clear that, you know, there are a huge amount of kind of obligations, expectations and requirements on banks, and they become more onerous the bigger the bank is, and, you know, the bigger the footprint the bank has in terms of where it actually operates, which I think just goes to show how complex an area this is.
Okay, and anything else to add, David?
No, I think Owen summed it up very well. I mean, there's such an onerous burden on the banks who operate internationally, and very few banks don't operate internationally because their customers also do business internationally. They have to comply with so many different regulations and requirements in different countries, in different continents. It really is a very onerous burden, and hence this is the reason why KYC is such a difficult and expensive function for the banks to deliver, and why there is now a focus on how can you actually make the function more efficient, how can you make it ensure compliance, but also make it more efficient and effective as well, lower the costs, ease the pain of the onerous burden that Owen highlighted.
Okay, great. Well, thank you very much both for
Such great answers. And my final question, and it's for you, David, is around blockchain and distributed ledgers, what thing that everybody's talking about. So do you think that blockchain and distributed ledger technology will make the question of standards redundant?
No, it's not going to affect the standards at all. And at the moment, as you quite rightly say, blockchain, there isn't a day goes by without blockchain being mentioned as a possible solution for one thing or another. But what I would add is the technology actually shows enormous promise to help with things where trust is a key requirement for a particular function or a service. So I can foresee the day when the UK government, for example, would be adopting blockchain to record key identity information. So, for example, when somebody is born, and also use that to give somebody a digital identity that they can then take with them, or that they can then use to identify themselves to whoever requires that identity to be presented, such as a bank or a credit card company or whoever it may be. And those sorts of blockchain in that sort of scenario, the government at the sovereign level could also start to attach things like your driving license number to your individual record, or your passport number, or even health records. The blockchain actually shows great promise. It's still early in terms of its maturity and its applicability, but I think it will have an impact on KYC in the relative near future. I think it will make life a lot easier in terms of customers identifying themselves, and will ease the burden on the banks.
Okay, great. Thank you very much. That I am sure is very useful to our audience, as everybody's talking about blockchain and distributed ledgers, but nobody seems to really know how it's going to be applied and to which extent. So before we move on to the questions from our audience, are there any final comments that either you, David, or you, Owen, would like to share?
Not from me, no.
No, that's fine, thanks.
Excellent. Well, thank you very much, gentlemen. And we are now turning to the questions from our audience.
Thank you, everyone. And we are now turning to the questions from our audience. So if you've got any questions or comments, please submit them via the chat box on your consoles. Thank you.
Live now. You start speaking.
Hello, everyone.
Hello.
So, thank you very much for your insights and the presentation. So we are now going to answer the questions from our audience. And we've got Owen Kennedy from the Bank of Ireland, and we've got David Harvey from Dell Services, and we've got another David Miller from JWG. So the first question is it good to outsource all of KYC operations or just parts of it? Perhaps, Owen, you'd like to start with that one?
Would you repeat the question again, please, Tanya?
Sure. So is it good to outsource all of KYC operations or just parts of it?
Yeah, I think it's very, very difficult to outsource all of kind of any operation. As I had said in the presentation I gave, for me, you know, this is about making sure that we've got resources pointed to doing the kind of right things. So where we have relationship managers. It's really about making sure they can actually spend an awful lot more time with customers, understanding the risk associated with customers, and it's the elements of the CDD process that are resource heavy and that are not really associated with actually managing risk. It will be those elements of the process that I would feel are more suitable for outsourcing, but not the entire process itself.
Okay. David Miller, perhaps you have a view on that?
Hello?
Hi, David, you there?
Hi, yeah, sorry, could you repeat the question? I just missed the question, but I heard the answer.
Sure. So is it good to outsource all of KYC operations or just parts of it?
I think it entirely depends on your business model. I think the important thing to understand about outsourcing your KYC is that don't make the mistake of thinking just because you've outsourced it, therefore you've also passed on the compliance. Ultimately, the buck will stop with the firm that's outsourcing it. So I think you just have to be careful as to how much you outsource and look at those contracts you have with your vendors and ensure that you're going to get the data that's validated. So when the regulator comes along, you know that you can sit safely in your seat that you've got the appropriate KYC data.
Okay, thank you very much. So moving on to the next question from the audience. How do banks make a business case for implementing a new client onboarding platform? Because usually, as we all know, it is last on the priority. And again, Owen, perhaps you'd like to start with this one?
Yeah, of course, yeah. I'd argue really in terms of why it is last. I mean, I think, all of us in the financial crime world have got an obligation to really push this forward and really to make sure that financial crime management is getting the kind of attention it needs. I would also argue that the obligations are there. The penalties associated with actually not meeting the obligations are huge. As we've obviously seen over the past number of years, both across Europe and the US. This is about trying to implement a process really that makes sure you meet your obligations in a much more effective and efficient, but an awful lot more consistent manner. So for me, the business case makes, it really kind of writes itself when you outline what the bank's obligations are. You outline how much it's going to cost the bank to do that manually. And certainly what we found is when you weigh up the cost associated with doing this manually versus the cost associated with doing it in a much more automated, consistent manner that puts you in a position whereby you're managing your risk better. The actual cost associated with the latter is actually an awful lot less. And that isn't even, I suppose, to really mention then, the benefit associated with having significantly mitigated your risk because, if we're honest, banks can't really afford the fines anymore. These fines are absolutely massive. There's a massive reputational impact associated with them as well. So I think it really depends on really how you step back and look at this. But for me, it's about weighing it all up and really putting the business case forward that outlines what the bank's obligations are, how much it's going to cost to meet those obligations in the traditional manual fashion, and how much it's going to cost to do it in a more automated, efficient manner, and I would argue a lot more effective. So yeah.
Great, thanks. Okay, so the next question is, how do you deal with the various KYC requirements that apply to each line of business within a bank? For example, wealth management versus corporate banking. And how do you believe technology helps bridge the human gap around linking up various departments to perform a common function in a common way? David Harvey, perhaps you'd like to take this one?
Yes, of course, Tanya. So I mentioned during the presentation when I was outlining the components of our solution that we actually start with what we call a KYC maturity model. So this is both to find out where the bank currently is and find out what processes they have or would like to roll out. So really we start by defining a standardized global KYC process, and then we can customize it by each line of business. And then we can look at particular regional requirements if the bank operates on a global basis, because there will, of course, be regional nuances and requirements that have to be built into the process.
Okay. Another David Miller. Would you like to add anything to that? No? Okay, well, let's assume that David Miller agrees. So moving on to the next question. So should banks be considering third-party KYC checks as part of the process? And under what circumstances? Who would like to take this question?
I might take it, Tanya. I'm not sure I necessarily fully understand the question, but if I can anticipate what it means, I think really what they're asking is whether or not there was alternative information out there on a particular customer, are banks entitled to use that? And I think the answer there is yes. You know, as long as we're satisfied that we're getting information from a reliable, independent source, you know, I would be absolutely satisfied that in order to supplement the information we already hold on a customer, the more information we can get from those sources that we're satisfied to rely on, having done obviously the required investigation into same. In those instances, I think it helps us manage our risk better.
Mm-hmm. Okay, I think, well, let's hope that answers the question, but it sounds very sensible to me. Okay, so the next question is, what is your experience in influencing compliance and regulations in countries where it is still a requirement for customers to open an account at a physical branch? Do you have such an experience, and could you share it if so?
It's probably one again for me. I suppose that's not something I would have experienced directly myself, but certainly my experience of kind of regulators is, you know, as long as you can reasonably outline a rationale in terms of, you know, why you want to kind of adopt a certain approach, I've always found them to be very, very, you know, very, very reasonable. Obviously, it is recognised that opening accounts where the customer isn't present, that certainly is obviously recognised as actually presenting a higher risk. But again, as long as you can outline and kind of demonstrate that you've recognised that risk and you've taken measures to mitigate that risk, which would include obviously undertaking further diligence and you know, providing further material oversight, as long as you can demonstrate you've recognised your risk and you've actually done that. My experience of regulators is they're always very, very open in that regard.
Okay, well, thanks a lot. My next question is perhaps for one of David's or both David's. So how much less is automation as compared to manual percentage-wise, if you've got these figures?
So this is David Harvey. It sort of varies between the customers we speak to, and it also depends upon their maturity and their business model as well. You know, do they operate locally, nationally, or do they operate globally? But certainly putting in place an automated system, and that's really what we're talking about, where we can automate things that can be automated, but also provide skilled resources to undertake the due diligence and investigation where two eyes are better than technology. It's sort of hard to say, but the benefits, as I mentioned in my talk, typically we see a cost reduction of up to 30% in terms of the cost of providing the service. But also it will then free up your relationship managers, for instance. Owen mentioned this, to actually spend more time talking to the customers.
Okay, David Miller?
Actually, I would say that was a pretty comprehensive answer, and I don't have anything to add to that. And in terms of percentage-wise, I mean, like it's been said, you know, that entirely depends on the business model. But the benefits to be gained from automation in the long run, despite the fact that it might be a high capital expenditure initially, by far outweighs the expenditure of doing it manually in the future.
Mm-hmm. Okay. So another couple of questions, and I think we'll be wrapping up. So the next question is, currently banks automate risk and authentication scores. So how do these scores assist with the KYC process? Is there still a lot of manual work outside of the scoring process?
I might take that one, Tanya, if that's okay. It's Owen here. The way we actually approach this is the automated risk assessment that we use is really a tool to outline and to highlight those cases that we want to pay a lot more attention to. So this certainly isn't an exercise in trying to minimize the work we do. This is really an exercise that we undertake to make sure, again, that we're actually applying resources in the right areas. So as long as you've got your risk assessment tuned correctly, you can stand over the fact that certain customers are low risk or medium risk, and you're therefore doing a lot more in terms of gathering further information and doing a lot more diligence in terms of customers that are considered to be higher risk before you make a decision as to whether you want to onboard those particular customers. So I suppose in my mind, these tools, when they're used properly, are actually very, very effective in terms of ensuring you're pointing your resources to the right areas.
Okay, great. David, any comments on that?
No, I think Owen captured it very well. I don't think I can add to that.
Okay, great. So now the last question, and I guess you will all have something to say on that. So what are the greatest challenges, in your opinion, that still exist? David Miller, let's start with you.
Hi. Speaking to the customers that we have, it seems that one of the greatest challenges that still exist is, in terms of KYC, getting their heads around FATCA and the FATCA requirements, and also preparing in relation to that CRS, which will come into impact for a lot of firms. But also making sure that they've still got procedures in place for AMLD, so money laundering directive in terms of KYC, and some of the inverses of the requirements. So for identifying PEPs, how do you de-PEP? These are still challenges that seem to be facing many firms.
Okay, great, thanks. David Harvey?
Yes, well, I mentioned, again in the presentation earlier, all the banks are already performing KYC checks. Some of them have automated the systems, like Bank of Ireland. Others are in the process, and others are still operating very much manually. So you could argue that things are okay. You may be able to do so. However, you can make the whole process more efficient, and you can make it easier for customers and a better customer experience if you do go ahead and automate the processes and add the customer experience methodology to make it simple and easy and all those good things as well. The challenge to actually roll it out is very much around the culture of the bank. How do you create the support for doing this? And typically it would be the chief compliance officer who would be driving any enterprise changes. How do you share the benefits, the potential benefits that can be gained by automating your systems and getting all the business units, both the business, IT and operations, all on one side? And this sort of becomes part of the governance as well. It's about getting the entire bank behind the changes that you want to introduce for both business benefit and to make it a better and more enjoyable customer experience for your customers.
Great, thanks. And now, last but not least, Owen.
Thanks, Tanya. Yeah, for me, it's really about, look, for any financial crime framework, there's actually a number of kind of different strands. So obviously the piece we're talking about today is the whole KYC element of it. However, there are certainly other strands which would include payment screening, which would include the monitoring of activity on customers' accounts to ensure that that is in line with actually expectations. The biggest challenge for me really is how we make all of these different branches, I suppose, speak to each other to make sure that we get a holistic, consistent view of each individual customer. So we understand the customer's risk rating, we understand the KYC elements of the customer relationship, but we also understand everything in relation to any payment screening alerts that we would have had, or any transaction monitoring alerts we actually might have had, so that we get that overall consistent view. Personally thought it's this single customer view that everybody mentions, but for me that's probably the biggest challenge.
Great, thanks. Well, I think we'll wrap up now. So thank you very much to our experts for their presentations and points of view. Thank you to our audience for listening and for the great questions. And that's it. The show is over.